Ladies and gentlemen, good day and welcome to Strides Pharma Science Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. And now hand the conference over to Mr. Abhishek Singhal. Thank you and over to you, sir.
A very good morning and thank you for joining us today for Strides earnings call for the fourth quarter and full year ended financial year 2022. Today we have with us Arun, Founder, Executive Chairperson and Managing Director, and Badri, Executive Director, Finance and Group CFO, to share the highlights of the business and financials for the quarter. I hope you've gone through the results release and the quarterly investor presentation, which have been uploaded on our website as well as the stock exchange. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and must be viewed in relation to the risks pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Arun to make his opening comments.
Thank you, Abhishek. Good morning, everybody, and thank you for joining in early. This is a very unusual time for a typical Strides earnings call, as we had to announce the results quite late yesterday, given some of our directors were overseas. Thank you for that, for the accommodation, and look forward to this engagement. So before I start, let me start off saying that while it has been an extremely challenging year for Strides, and we see green shoots, as a promoter and as a founder of the company, I take full responsibility for the events of the last year as regards the organization's performance. It is easy to rationalize on COVID, the business environment and other elements, but it is critical to accept responsibility, fix it, and move forward. I'm actually very delighted to say that I'm happy to come back to work full-time at Strides. And as a family, we are fully committed to ensure that Strides gets back to its previous glory or past glory, if I may. And we are determined to institutionalize the organization to face challenges of the environments that we face or any future environments that may come our way. I also give credit to the fact that while we've had a difficult year, we had a set of extraordinary people staying fully invested with the company and its opportunities. We have, with my coming back on April 9th, although I started getting involved into the business a little earlier, first of all, I want to thank all the leaders who served the company in the last 2-3 years and have moved on for other interests or for the reason that the company has revisited and recalibrated its strategy. Having said that, I'm very happy with the team that we now have in the organization. And apart from my coming back, I'm also delighted to welcome Venkatesh, who will now head our U.S. business. Venkatesh, until very recently, was the CEO of Alchem's U.S. business and Micro's U.S. business before he joined us. Being a seasoned professional with deep experience in the market, he will lead our sales and marketing activities in the U.S. And U.S. continues to be an important market irrespective of the business environment it currently operates in. The transaction with Endo, in my view, is extremely accretive to the organization. The integration of the Endo business, which actually technically integrates to us only from June 22, is an important milestone to our reset and recalibration strategy. To have Venkat leading that business is an extremely important step that we have taken. And I also wish to thank Terry, who not only got us the transaction closed, but also integrated and is in the process of handing over the business in a seamless manner to Venkatesh and his team. So Q4 nonetheless has been a much better performance, especially coming back after 2 difficult quarters. We are seeing green shoots across all our businesses, in spite of the in the doom and gloom, we have had some outstanding outcomes. For example, our U.S. business has started to pick up. We are now confident of hitting $250 million guided. This is not going to be telescoped towards H2 or it's going to be linear, which effectively means we will see growth pick up fairly quick, and as early as in H1, we should get into a linear situation with our numbers in the U.S. That will give us a lot of headway to build the business from there on, considering that we have over 150 products that come through the acquisition. We have a strong plan for a launch of 20-odd products per year starting now. All of these products are approved, so we are not dependent on any regulatory inspections or facility inspections, as these are approved investments, as approved ANDAs. More importantly, in the U.S. especially, we are sitting on significant inventory as the volumes dropped in the last year, and with the volume pickup being quite significant, and we are already seeing growth in volumes as early as this quarter. We believe this will improve our cash flows quite dramatically. This is an important step for us to bring our balance sheet size in order, apart from the fact that we have guided that we will reduce our debt by 1,000 crores through a combination of the fact that we have now successfully managed to, we have requested, and our partners in Australia have been very kind to bring forward our payments. So we expect to receive these payments in H1 against December 31 as previously contracted. This is going to help our debt book quite a bit. And also the fact that we have reset the businesses to focus on large businesses where we have complete control on cash flows. We would exit minuscule and tiny businesses which do not move the needle for us for revenue or EBITDA. That and free cash generation will significantly help us achieve our stretch target of reducing debt by 1,000 crores and bring the company back to a very solid exit run rate of to be under 3 times EBITDA. This is a task that we have set for ourselves. We're very confident of achieving it. This will also be aided by strong performance in other markets outside of the U.S. We reported in Q4 our highest quarter in the other regulated markets, with strong pickup coming in post-COVID in the last 2 quarters, and we believe that we'll see a similar pickup in the U.S. operations in the coming quarters. The emerging markets continue to grow. Of course, it's subscale, but it helps us in our manufacturing under recoveries, and we will continue to focus on that business and build from where we are in terms of top-line growth. The margin flow-through is not very significant, but the absorption is very, very important for us. We have a series of cost improvement programs that includes a very significant relook at our cost structures, reducing the complex natures of our international businesses, reducing the number of subsidiaries, operating companies more in matrix and sometimes in a functional leadership manner, reducing costs consequently. And we expect our cost improvement programs will enable us to get market leadership in several products and also reduce the cost structure quite significantly. Given our significant investments that we have and approvals that we have, we are reducing our R&D investments into the U.S. as we don't see the need for significant R&D investments for the next 3 years. Although we will keep our eyes open and continue to file critical products that we believe are important for our domain and niche strategy. So that will continue, but we will not be a 25-30 product filer anymore in the U.S. and shift the focus to develop, to launch our products that are already approved. What Endo has done for us, the transaction with Endo has done for us, has clearly solved what used to be an acute-only strategy, which worked very well for us pre-COVID, but COVID clearly exposed the portfolio strategy gaps. And with the combined portfolio that we have from Endo and Strides, we don't have any more excuses on our narrowness of our portfolio, And we strongly believe that the new domains in controlled substances, hormones, and nasal sprays will give Strides enough ammunition for future growth and also product launches. We have created significant working streams, clearly laid out scorecards for our leadership to execute across globally. We're all working in sync to create what we call the One Strides and build a company of scale and size, which I'm sure that you will see the results flowing through in the near term. I won't dwell too much on FY22. Some of the key issues obviously was that a significant drop in the gross margins. For the first time, we had a drop in revenues, although Q4 has started to look differently. We had a 16% increase in operating costs, employee and other expenses. We obviously are sitting on significant inventory, which we are now already seeing a normalization. We expect this inventory to be normalized to the extent that we need to have by the end of the year, releasing cash, but also then starting on the under-recovery process in our plants, considering that we are sitting on large inventories. We obviously are not filling in new stocks until the stocks are getting over. So this year is going to be a very important year on razor-sharp focus on execution, margin expansion, and also bringing the balance sheet to size. The detailed deck has got individual slides on the U.S. For example, the U.S. sales has moved from 38 to 44 million, and if you're guiding the street for $250 million, then obviously this needs to be closer to a $60 million run rate. We are very confident that we will get there very soon, and that's mainly to do with the integration of the Chestnut Ridge operations in the U.S. We are expanding significantly our other reg markets, and in any markets that we are not present, we have significantly secured new partners, and we are working with key on increasing our B2B IP-led B2B profit share model across Europe and markets that we do not want to operate ourselves in the front end. And we have exited many markets like Canada and some parts of Europe where we can't scale. But in the markets that we can scale, we are putting all our energies to become a leading player with OpEx leverage and significant margin expansion. Our emerging markets, especially our Brands Africa markets, was not impacted by COVID. We all know that COVID was not as severe in Africa, especially in Northern Africa where we operate. And we continue to benefit from those and our margin expansions. Productivity of our sales reps, now numbering about 160 odd sales reps in French Africa, and continuing to introduce new products will ensure that we will have an improved sales in those markets. There are a few markets in Africa that we operate that we are now revisiting if it fits into our overall strategy of scale, that if you're not a top 5 player in a domain or a frontier market, then does that make sense for us to be in? And we're reviewing those, but none of that is going to impact what would be an important year for sustained substantial growth in top line and EBITDA. We have a very detailed deck this time on how we propose to reduce our debt, and during when we open the house for questions, we'll be more than happy to answer any specifics. But we also have detailed explanations on Stelis. We believe that Stelis has done extremely well as a pure play CDMO in its first year of operations. We have a revenue model which we have articulated in our deck. We have two parts. We have two businesses, mainly the CDMO business, where bulk of our investments have been made, and with the completion of our new site, we now have amongst the top 20 global capacities in microbial and mammalian manufacturing capabilities. but we are one of the few global players which are fully integrated from cell line development to fill finish. We are delighted to have onboarded 6 customers in our first year. In the first 3 months of our operations in this quarter, already we have added another 6 new customers. Master services agreements that we sign up with these customers are always linked to a contract for supplies, and our supply book is now in the vicinity of 100 million for the first years of master service activities that we have done. Now, just that this, you understand, it's understood well. A master service agreement typically leads to a commercial supply agreement in about 3 years. We are approximately a year and a half away from breaking even that business. Outside the challenges of Sputnik and the sanctions on RDIF, which we are finding all kinds of solutions to resolve, including taking the help of the government of India to work with their good offices with the Russian government to find solutions, as we are sitting on inventory of a sale value of close to about $40 million. Is extremely critical for us to find a home, and we are working through it. Luckily for us, our dating on that is of our stocks are good. We still have 12 months of inventory, so we don't see any risk for the next 3 to 4 months. So the next 2 quarters for Stelis is extremely important as we find a solution for Sputnik. But more importantly, our own COVID vaccine, which is called AmbiVax, which is in license from Axton Biosciences, has completed the full dosing of its phase 3 patients in India. As some of you may know, we have an EUA status on this product issued by the government of India, and we have now applied for a booster study across all variants, and this being the only or the first or one of the few thermostable vaccines which doesn't require cold chain. I mean, it requires cold chain but normal under 25 degrees, makes AmbiVax a very unique vaccine, and therefore we still believe that there are a lot of legs left in this program. Outside of that, the CDMO business will do well. We expect the MSA contracts for this year will help us operationally break even, and we have existing investors have got an additional $70 million, $65 million of commitment of capital, which everybody is committed to invest. Consequently, we don't see any challenges for the funding of Stelis. Of course, this does not include the fact that there continues to be ambiguity around Sputnik, but we want the next 3 months to resolve for this and to also see how AmbiVax itself progresses, because we are expecting to submit our phase 3 final clinical data to the government of India by middle of June. So there's a lot of important milestones. Most interestingly, the facility we have 3 plants, 2 blocks were inspected by the EU authorities, and we are expecting formal approvals, but we had great outcomes, and consequently we are seeing a strong inbound of customers. Stelis' CDMO business is unique, considering that we do not do small contracts, we do service contracts only with supplies, which makes us a very uniquely different biological CDMO compared to other players in the country. And with the size and scale of what we have achieved, I am extremely confident that this will be an important pivot for Strides. We have also announced that Stelis 2 significant announcements with regards on the business development. We have a stellar team in-house who's worked in the last 2 years building out this business. But as we grow global, I'm delighted to welcome Frank and Dr. Axel, both veterans in the biotech CDMO business development activities, having more than 25 years of experience respectively in both in Europe and in the US, and with deep connects to big pharma. So I'm quite excited about the opportunities around Stelis. I know that there would be questions on what are our plans for Stelis. We have put all our plans for Stelis on hold till we find a solution for Sputnik, till we hear about Ambivax, and we continue to see value in us to convert some of the major customers that we are expecting to convert in this year. We have been announced of a US FDA inspection. That's a very critical milestone. So in the next update, I think we'll have lot more news about the limited ambiguity. I mean, the 2 or 3 elements which are still ambiguous. But we are right on top of matters, and we're very excited about our investments in Stelis, and we look forward to address any specific questions. I must also apologize that most of you may not have had time to read through our very detailed explanations, including our slide on extraordinary items. And if there are, and we believe, and we know that it's a busy day for many of you, so we'll be more than happy to take calls from any individual investors or analysts who may want to ask us questions, and please write to us or to Abhishek, and we'll be happy to address. And we now are happy to take any questions that you may have.
Neeru, can we open up for Q&A, please?
Thank you very much. We now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Anyone who wishes to ask a question may press star and 1. The first question is from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah, thanks a lot for the opportunity and the elaborate explanation on improving the performance going forward. So just would like to understand on the US front, like the Indo portfolio would have a similar gross margins as the Strides portfolio in first place?
Yeah, that's a fair estimate.
So secondly, even on the Strides side, we had good number of products which were already approved. But if you could just explain any reasons for not able to launch in the past, and then what gives you the confidence that they would be still a very profitable going forward as we launch in the coming years.
So Tushar, in out of the 200 or 150 odd ANDAs that are not launched, more than 100 of them came through the several inorganic transactions, small ones we did earlier, and now with Endo. Many of them needed significant improvements in terms of cost, so which means vendor changes. Some significant changes mean that the past approvals from the FDA can go up to about 6-8 months of work from our side and 6 months of approval time. We are now received several approvals, and we continue to receive several approvals of key products on a regular basis, and that is why we are now committing to launch at least 20 products from the current 55 to 60 odd products that are launched. We should be able to take that more than 20 per year, but 20 in the minimum.
And given that there has been good amount of price disruption, I mean that is what we hear from the peers. So on our existing portfolio and even on the Endo portfolio, what kind of price erosion we would have experienced?
So we, in FY22, the price drop was very significant. We dropped. You can already know that the fact that our gross margins have dropped by 10%. The drops have been, in some cases, as high as 30-35%, in some cases as low as 10%. But what we are seeing is, not across the platform, across some products, especially in our portfolio, especially in acute to be fair, we are seeing prices, either people who disrupted the market now no more operating after having got rid of their inventory because it doesn't make sense to play at those prices. So we are seeing rebates, we are bidding at higher prices, we are winning businesses, and we are growing our base business. So we are not seeing, I think our value deflated, our revenue deflated from almost $200 million to 230 odd million dollars, if I'm not mistaken. 160. So we had a $50 million revenue deflation. We are now very confident of getting back the base revenue this year itself, and then add it with the endo portfolio, and that's what makes our 250 million quite feasible. So we are not seeing more deflation on our portfolio, because if we are seeing, we are obviously not winning or bidding for them because it doesn't make sense. But overall, given that we have the luxury of so many unlaunched products, and with the fact that we started the cost improvement programs probably 2 years ago, we are very close, and we are getting some very nice approvals as we speak. They are small, but they are very nice and niche, and we'll see some more in the next couple of months. We believe that the margin uptick will come on the 250 million. I don't see a drop in margins from where we are, but it won't be across the board that we'll be able to improve the margins. But it's going to take us some time before we get back to our historical 60% gross margin. I mean, to be fair, our U.S. gross margin was 70%, and now it's about 60%. So getting back to 70% is a long haul. And I think somewhere between 60 and 65 we should settle in the U.S. and then kind of recoup at least 3 or 4% of the global gross margins that we've lost in FY22. And I'm quite confident about getting that.
Understood, sir. And going little below the gross margin, you have elaborated on good 300 bips improvement in the logistics cost. If you could elaborate, and this could happen over what period of time?
So last year, because of the supply chain disruptions, especially with input material, either we were sitting on too much of inventory, which means we were paying for very expensive warehousing costs in the front end, and these are not cheap because we pay by the week, by pallet. So normalizing that when you're not shipping new goods and getting pallets out of UPS and warehouses, that obviously will reduce our cost. But more importantly, with very stringent focus on our AOP or annual operating plan, which gets constant updates, we are now producing only to demand and not to estimates. So because we have a lot of inventory, we don't really have to rush anything by air. So from end of September, except for extraordinary opportunities that adds to our $250 million uptick, we don't see the need to send any goods by air. So although sea fares have gone up from an average of $6,000 to now $25,000 per container, and containers are not available for the U.S., as you would have probably heard from many other peer groups. The fact that we are able to take off even more expensive freight costs from air into sea will reduce the cost. And most of the cost reduction will come from front-end warehouse reduction costs.
Got you, sir. So considering the improvement in the sales and the reduction in the cost, we are currently at about 5% EBITDA margin as we ended FY22 in fourth quarter. So what kind of EBITDA margin can we think of for, let's say, in FY23?
Well, I can't guide you for a percentage margin. Our focus is to focus on revenue growth. Revenue growth will get back our volumes, and not necessarily only from the U.S., from all markets. That will ensure that our capacity utilization in our plants will improve, leading to lesser under recovery, which is important. And we expect, if you go to our debt book, you'll see that we expect to exit at least at 150 crores of EBITDA for us to be under 3 times debt to EBITDA after reducing 1,000 crores of debt. So I think our focus this year is about solving for inventory, improving our cash flows, reducing our balance sheet, and to improve growth. And when all of these inefficiencies that have been inbuilt in the business because of COVID or whatever we want to say, will normalize to what we traditionally. I hope the idea is that by the end of the year we should be in between the 16-20% range, if that addresses your question. But yeah, and you would see growth Q on Q from here. I think we're done with the bottoming out of the business. We're seeing growth coming back, and we are excited about the opportunity Chestnut Ridge brings. In some of parts, we are confident to get there. But I can't give you an exact finite number. I think the focus this year is focus on growth, improve capacity utilization, reduce inventory, improve free cash, get out of few businesses that don't make any strategic or value sense in the near term, and yet grow the business from where we are. All of this will lead to significant improvements to the overall business. And I think you should be asking us percentages more closer to H2 and closer to the end of the year.
Sure. So actually, the perspective was more of,
Can I request to come back in the question queue?
Just one last, if I may.
Go ahead, Tushar.
So just on this 450 crore debt reduction, that would be largely from the internal accruals, or because
yes.
The kind of margin trajectory which we are kind of building from the point where we are today. So just to understand that trajectory.
Yeah. So absolutely. So free cash generation from, we are sitting on inventory which is being exhausted this year. And I think that when I look at exits of minor P&Ls, we are not talking of anything more than about 100 or 150 crores in that range. So it's nothing significant. It's just that we want to focus on the bigger outcomes. But otherwise, even if we don't do any of that, we are confident of free cash generation to that extent.
All right. Thanks.
Thank you, Tushar.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Vinay Bafna from ICICI Securities. Please go ahead.
Thank you for the opportunity and good morning, everyone. I have a couple of questions. So my line was a bit patchy at the start, so I just want to clarify. We are assuming a $250 million annual sales for the US business next year, which is and you highlighted in your statements that it will be linear. So we are assuming a $60-odd million quarter run rate, which is approximately 35% sequential growth. I understand it might not be entirely in Q1. However, I just want to understand how much of it will be contributed by the endo, and considering our plant at Puducherry is still under regulatory concern, what is the dependency on that plant as of now?
Well, our Pondicherry dependency is zero because we have site changed all those. I mean, we have developed those for almost all products from our other sites. So and they are not material at all. We don't need any new. So to launch any approved product, the OAI in Pondicherry has got no impact. You can launch a product from a site if the product is already approved, right? So we don't have a problem with that. So Puducherry is really not a challenge. It'll be hard for me to give you specifics of how much is from Chestnut and how much is coming from India, but I can give you an indication that Chestnut Ridge will add an annualized. So remember, we take charge only in June, although we are starting to consolidate some of the businesses. We expect Chestnut Ridge to have an exit run rate of about $25 million a quarter in this year to our top line. But I can't give you the quarterly outcomes on Chestnut Ridge.
No, that is very helpful, sir. So if I understand correctly, then at least at the initial part of the first half is going to be driven by our internal growth. So considering the bump up
we do have some Chestnut Ridge products that we took charge as soon as the deal was announced. So there is a certain amount of value, but the bigger product launches are happening as we speak. So you should watch Q1 and Q2 for launches out of Chestnut Ridge.
Okay, got it. This is very helpful. Secondly, sir, we have said that we've gotten an upfront payment from our partners in Australia. Since it was a payout which you're expecting several years later, does it impact our agreement for those steady sales which you do over there? And how much of the payment is left to receive from there?
Well, first of all, it's not several years, it's only a few months. The payment was due on 31st December 22. We should have the funds in our bank in H1. So it's a few months in advance, at best 6-7 months. So that's what is important. It's maybe 5-6 months, if I may. And our contract for supplying to Aerotex is for 10 years. So we don't have any challenges on that. In fact, that business will grow from where we are.
So do we have any more payment left from their side for this agreement, or is this the last tranche?
This is the last payment.
Okay, got it. Last bit is, you did highlight a bit on the logistic cost for the previous participant. But what we understand is that it was a significant jump during the quarter, and you also highlighted how the air freights have gone high. I'm sure that you've taken up several measures and you were highlighting how you want to reduce it. But considering how the situation is and what the peers are saying, no one's really talking about these costs going down. You want to highlight anything very specific wherein we're trying to save on costs?
Yeah, so like I said, a large part of our logistics costs include our front-end warehousing cost. So if you're sitting on inventory which you sell out over 6 months, then you're sitting on too many pallet stations that you pay too much of rentals on a monthly basis, on a weekly basis, correct? So if you're not loading new pallet stations because you are not producing new until the stock is resolved, your logistics cost automatically comes down in our case. So it's not a peer-to-peer comparison. The fact that our volumes dropped last year by more than half, but our AOP was the production was for almost all the annual operating plan. And that's how this business works, because if you do not have inventory in the front end, then you will not win business. You can't win business unless you have stock in hand. So considering that we have enough inventory for at least 3-4 months compared to the average 2 months, that itself and that normalization itself will reduce our logistics costs. I'm not taking away anything from the fact that, so in effect, to sell the same dollars or more, we'll be shipping maybe 40-50% containers less than what we shipped in a bad year. So that is it's just a normalization. It's nothing to do with we getting any better prices than anybody else is getting with container freights.
Understood. But then I have actually 2 sub-questions to it also. This will be the last of them. First part is that since we are sitting on such high inventory and we are wanting to liquidate them as well, considering obviously there'll be a shelf life issue as well with them. We are still assuming a growth on our base portfolio largely because of the volume driven. So isn't it a bit contradictory? At least maybe you can help me understand that we are trying to push more volumes, but we're not expecting a high
I'm not pushing any more volumes. During COVID times,
even if the demand is coming in, it'll be at a cost of price unless that situation is completely.
It's not coming at a cost of price. In the acute therapy, the number of players continue to be few, in which what Strides flourished its strategy. So in the acute, when whoever dumped the product is no more in the market. In fact, that market has become more attractive for us as the number of players have probably even reduced further. The volume drops. The volumes have started coming back with prescriptions coming back, which effectively means that we haven't lost market share at all. So it's just that our market share, let's say on ibuprofen, was 28% or 30% for many years. It hasn't changed in COVID. But now if the volumes move up by 500 million units, so your 28% share also moves up by 500 million units. So it's nothing to do with us selling at a cheaper price. That's not what we do.
Got it. So it's just that our product baskets are benefiting from the situation which is improving at the macro level, which is fair enough. Got it. That's all from my side. Thank you, sir.
Thank you, Vinay.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Gautam Bahal from Orient Capital. Please go ahead.
Hi, Arun. Thanks for taking my question and for the detailed presentation as well. So a couple of them. I'm just trying to make sense of slide 16 that you guys posted last night. Would I be right in interpreting this as in Q4 you had 77 crores of exceptionals to your EBITDA. So you would add 46 to 77 to get to 123. Would that be right?
Sorry, Gautam. Could you just you kind of faded in between. You may want to just repeat your question.
So slide number 16 in the PPT.
Yeah.
It's non-operational items slide.
Okay.
So trying to interpret that, would that be right that in Q4 you had 77 crores of exceptionals which will not be repeated going forward?
Yeah, that is correct.
So to interpret the Q4 number, you just add the 77 crores to the 46 crores of reported EBITDA, just the reported EBITDA.
No. See, what happens is, the company has got an accounting policy traditionally in the last many years they have been reporting all these line items and exceptions, and these are all exceptions. Whenever there is a product recall and it is triggered by a PAB, take all of this here, and it is consistent with the past practice, and this is of a one-time nature predominantly.
No, so just trying to understand the 46 crores that you have printed as well as your consolidated EBITDA. If we were to adjust the 77 crores,
that doesn't have any adjustments.
Yeah.
So it should be taken as. I'm just trying to get to the sense that if we add 46 to 77, that already implies a 14% margin. Is that the right way to think about it or not?
No.
Okay, fair enough. Maybe I'll reach out offline on that one. The next question, Arun, is the 1,000 crore debt repayment that you've outlined. Does that include anything to do with Stelis secondary sales at all?
No.
Okay, good to know.
Then we will have no debt.
And one more, I mean, I guess you have implied this already, but when you say 3x debt to EBITDA, that implies a 650 crore EBITDA. Would that be right in FY23? Run rate in Q4 in the exit quarter or something, I guess.
Yeah, we are pushing to be better, but that's the target.
Okay, and that also implies around a 16-17% EBITDA margin run rate at exit.
Which is what I was alluding to to an earlier question from Tushar.
Okay. And Arun, given that we are almost 2/3 through Q1 already, are we sort of trending towards these better numbers? Are we trending towards 60 million quarterly run rate in the US already, or not yet?
Well, our headline says guides for an encouraging FY23 outlook, which effectively means you're right. If we are very close to June, we probably know what we're telling you. And if we are headlining our US sales to be near linear, then the answer to both your questions is yes.
Okay. And last one from my side. Where does there's a lot of moving parts now on the top line and on the cost line, right? Where does the business settle out in a couple of years or 3 years from now, Arun? Like, is it
on these lines moving for everybody in the industry? I mean, all these lines keep moving. What exactly is your question?
No, my question is, where does it settle out in 2 or 3 years in a normalized basis? Do we ever see a 20% margin again on this business? What's your thought?
Absolutely. We don't see any reason why we won't be there, and that's because of the diversity of the business. I think all the emphasis of the people who look at us is for the US, as is the case. Please look at our other regulated markets business, how quickly it's growing, how rapidly it grows. It doesn't have the SG&A and costs associated to US. So while you may run a lower gross margin, the flow-through margins to EBITDA is stronger. And you'll see lumpiness from here on because we are adding several new markets. but the base is a very solid base, and I won't hesitate to say that we are now amongst the top 10 players in Europe in other regulated markets out of the country. We want to focus on that market. We've got lots of opportunities and product approvals coming our way, but it doesn't get too much attention. But that's where our focus is, because it's a massive market. There's been massive consolidation of national players in Europe. The big players are hurting for portfolio supply chain, and we are partnering with them on profit shares and no contract manufacturing activities. And we are seeing an uptick in our business, and you'll see more and more of that in the next 2 to 3 years. Mirroring US, the other egg markets in 3 to 4 years is the goal for the company, and that's what is going to make the OPEX leverage very, very different, and the EBITDA flow through will be very different. And we're very determined to get there with that strategy.
Okay. I appreciate the color, Arun. Just a final data point. What is the sort of maintenance capex we should build in for this year, approximately?
Well, the good thing now is that when your capacity utilization is low, as you're building up, you have inventory and you don't have to use all your plants. We have the ability to, move one product from one facility to another, considering we have several FDA-approved sites. So we are going to be very low on capex. Our typical capex will be about 100 odd crores per year for the next 2 to 3 years. There is nothing major that will go into investments in terms of capex, because all our plants are well equipped and have got large capacities and enough capacity for the next 2 to 3 years in terms of build out.
Understood. Thank you, Arun, and I look forward to a better year. Thank you.
Thank you, likewise.
Thank you very much. We'll take the last question from the line of Nitin Agarwal from DAM Capital Advisors. Please go ahead.
Hi, thanks for taking my question. Arun, on the US, you've talked about increased RFQs and all coming in the market. So for oral focused player like us, what is this really implying? Is it implying more volumes, or are you seeing some improvement in the pricing also?
So there are two things, Nitin. One is, if I am sitting on too much of inventory, I can go and, it's an existing incumbent by giving a price. And then how it works is that I get a ROFO to accept that price. And in many cases, we didn't accept the price, so we exited the market. And once the inventory was exhausted, you can serve a notice saying that I don't want to supply after 90 days or 180 days. And then typically the customer then comes back to the market for a new vendor. And that's what I mean. So for about 3 to 4 months post-COVID, and when US was slowly picking back, nobody was getting any requests for quotes. But now it's back to normal. Of course, there is price intensity in some products, but especially in our acute products, we are winning back the contracts. We have many contracts that we have lost, we are winning back. They don't move the needle much in terms of revenues, but they move the needle a lot in our gross margin uptick.
On the Chestnut portfolio, we've talked about how complex the presentations like hormones, patches, hormones, etc. By when do you see some of these things begin to get commercialized for us? Those complex sort of non-OSD formulations?
So you can look at our hormone launches in Q2. You can see our controlled substances coming back, which are not being currently sold, coming back in Q4. But there are several special products, especially products like Megestrol, where we may be one of the only few players in the market. You will see us coming back in that product as early as this quarter. So we are, now that we have complete control of the business starting in a couple of days, rather, or a couple of weeks, you will see more launches coming out of Chestnut Ridge and from here. So by H2, I think you will see the momentum of launches. But one of the reasons I'm giving you more a linear guidance on US because we are also giving Chestnut Ridge the attention it requires in terms of market share. So we are gaining market share in the products simply because when Endo was exiting the market, they obviously, for the right reasons, didn't pick up new contracts as they were not willing to take the liabilities of supply. But now that we have started bidding and winning new businesses, that also adds.
Okay. And lastly, on your debt, I think the question has been asked a few times, but on the guidance, what the guidance really implies, X of the investments in CHC and Stelis, a net EBITDA number of about 1,500 crores or thereabouts, net debt number of 1,500 crores or thereabouts by the end of the year?
Net of investments or debt to EBITDA on the pharma will be under 2 by this year.
Okay. Thank you.
Exit run rate, don't mistake me for that.
Yeah, got it. Yeah.
Thank you. I now hand the conference over to the management for closing comments.
Thank you everybody for coming in this early and appreciate your time and questions. I'm sure that many of you may have follow-up questions. Please feel free to write to our investor desk or with Sandeep or Abhishek or even to me or Badri, and we'll be more than delighted to answer your questions. Have a great day ahead. Thank you.
Thank you very much. On behalf of Strides Pharma Science Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.